Hello and welcome to this show. We're live with Dan Ahrens, Managing Director and Chief Operating Officer, also a portfolio manager at AdvisorShares. How you doing today, Dan?
I'm doing well. Thanks for having me on, Brian.
So how did you find your way to AdvisorShares?
Sure. I've been through a couple funds in the past. Back when AdvisorShares was first getting founded, a little over 12 years ago by Noah Hammond. He had known me from some past funds that I had managed and got a little notoriety for, and wanted to hire me here at AdvisorShares. We had one of the very first exemptive reliefs to do actively managed ETFs. So everything here at AdvisorShares is actively managed ETFs. ETF rules have changed a few times since then, and those exemptive reliefs that were extremely valuable, and we were on the front end of that. Now fund companies can launch ETFs just a little bit easier, and that's a good thing, bringing more people to the space. But AdvisorShares has about 28 funds now, all actively managed. We manage some funds in-house. We have a number of other funds that are sub-advised by people like Dorsey Wright and Newfleet and Gerber Kawasaki and a number of different names out there that sub-advise funds for us. So we cover a lot of different ground, thematic funds, funds in certain industries.
And these are pretty niche products. How do you see, first, the individual investor? How do you see the individual investor using these? Is it more of a targeted kind of short-term in and out, or are they long-term holders working on a particular theme?
Sure, great question. I think that with actively managed ETFs, we're usually talking about portfolio managers and certain types of themes that are meant to be long-term buy and hold investments. We simply think an ETF, exchange traded fund listed on NASDAQ or the NYSE, is just a better mousetrap in most cases than a typical mutual fund. I came from the mutual fund space. Most people in our industry came from the mutual fund space in the past. Our funds are still what are called 1940 Act investment companies, to get technical on you. But an exchange traded fund is usually more tax efficient. It's listed on the exchange. You can trade intraday. You can use limit orders. There's a lot of reasons that we think an ETF is a little bit better structure. And we used to contact and target the fee-based investment advisor the most to use our products, use it in their asset allocations, have a good understanding of how these funds work. But over time, AdvisorShares has launched more, as you said, thematic funds in certain industries and certain sectors. And those have attracted more individual investors that it makes sense to invest in a certain theme if they want exposure to a certain industry, a certain sector. But having a professional portfolio manager picking those stocks, keeping an eye on it, might be better in some cases for some investors than trying to pick 2 or 3 or 4 or 5 or 6 stocks yourself and manage them all the time. So we like the thematic opportunities that we can bring to investors, whether it's a fee-based investment advisor or an individual investor that finds out about our funds.
Right. I think you touched on a couple key things there. First is that one of the key differences, obviously, between ETFs and mutual funds is the ability to purchase throughout the day. So if you see something that you're looking for at 11:15 in the morning, you can get it at 11:15 in the morning as opposed to 4 o'clock in the afternoon. The other big difference, not just between ETFs and mutual funds, but between in the ETF world, is the difference between active and passive. And I think most people think about passive because of the big behemoths and the space, and also that's the origins of ETFs, right? Yeah. People think of SPY. So let's talk a little bit about the active management piece of it and why you're not afraid of that.
No, I appreciate that question, and I'm a big believer in investing in large, low-cost index funds like SPY. But once again, if somebody's looking for a certain theme, a certain type of fund, we think an actively managed ETF can be an excellent way to do that. Now, the point of active management is to do better than an index, to try to add alpha over what an index could do. And it's hard for a large cap growth fund to outperform SPY. I think a lot of people have proven that. Some do it. They're hard to come by, but some do it. But in an area, some of the areas that we offer, one fund that we're going to talk about today is AdvisorShares Hotels ETF, ticker symbol BEDS, BEDZ. There are funds out there that could invest in that area. But we think in a limited universe of stocks, in a certain thematic area like hotels, it might be good to have professional management, knowing those stocks, getting good analyst information. Give me just a second. And I'm back.
All right, he's back. Had to tend to a little puppy maintenance there.
The beauty of home officing in these days that probably stick around forever. So as I was saying, we think in a thematic area, an area with a limited universe of stocks, we think we have an excellent chance to add alpha over blindly investing in an index. In certain areas like small cap and micro cap stocks, in certain industries, in certain up and coming industries, we think it's easy to get good information, be knowledgeable of the stocks, be good stock pickers, be good traders, and add alpha over what an index can do. In an area like hotels and travel, some of the very biggest names aren't necessarily the best names to invest in. So we like to use knowledge that individual investors might not have available, and then use that knowledge to overweight the best stocks and underweight some others. And I'll be frank, right now we are greatly underweighting cruises, the cruise lines. We're not ready to get back on board with cruise lines. We have a little bit of shares basically as placekeepers of Norwegian, Royal Caribbean, even Carnival. But we very purposely greatly underweight those stocks. And that's just an example of what we can do.
And what's nice about the transparency of ETFs is all the ETF providers are required to put their portfolios on a daily basis, really right on their website, and make that publicly available. So anybody who wants to go into AdvisorShares.com, pull up one of their ETFs. We're sharing the screen here for BEDS, ticker BEDS, as we said, and you can go right down the line and see their holdings in there and kind of page through them if that's something that you wanted to do. So we can get into that fund.
If people are pulling up, looking at funds, pulling up tickers, this is BEDZ, Z at the end. We didn't do that just to be cute, but the BEDS with an S wasn't available. So we have a couple of funds, EATS, which is a AdvisorShares Restaurants ETF. And here we're talking about AdvisorShares Hotels ETF, ticker symbol BEDZ. Now, Brian, as you said, the holdings are available every day. And we think that's a great tool to investors. Please look at our holdings, look at what we're doing. We are very happy being transparent with that. We think more mutual funds should be more transparent with their holdings instead of waiting for, a 15-day delay and then every month or every quarter or something. We like showing people what we're holding. As an individual investor, feel free to look at our holdings. I think it's good for two things. If you just want to get some ideas, copy what we're doing a little bit, you'll see that the top holding in our fund is something called Target Hospitality, ticker symbol TH. A lot of people might not know what that is. It's a smaller cap stock. It's not something you're going to see talked about on CNBC all the time. And again, very different than an index here. This is not the largest cap stock in the hotel industry, but we think it's a very, very good one. So look at our ideas. Feel free to invest in individual stocks. Or if you look at our holdings and you like what we're doing, then it makes sense. I think investors should invest in what they know and what they understand. And we like those holdings there to help investors understand what we're doing.
You mentioned the cruise world and said you were underweight that area. So why are you underweight cruises right now, Dan?
Well, a big reason we launched AdvisorShares Hotel ETF and AdvisorShares Restaurants ETF was right when middle of COVID. We knew that these types of industries were suffering with COVID. We're getting government assistance, things like this, and then would probably bounce back in a very big way. We didn't want these funds just to be COVID bounce back plays, though, because we looked at these industries and thought, this is a very much global story. It's not just the United States. People are traveling more and more. The entire planet's getting more globalized, where people are traveling around the world. We see that trend continuing indefinitely. And we like the hotel industry for the long term. But quite obviously a COVID bounce back play here. Now, if you looked at our fund a year and a half ago, I was saying things that were very much heavily weighted in leisure travel, in vacation travel, because business travel wasn't coming back quite yet. And the portfolio looked a little bit different. Over time, we've now gone much more into some of the biggest brands like Marriott and Marriott Vacation Club and International Hotel Group, IHG, while still mixing in some certain plays like vacation clubs and others. But cruise lines suffered an awful lot with COVID. There was a couple COVID cruises that had people locked up on those. And that was even following, prior to COVID, some stories coming out about certain cruises with there was some fires, there's some broken down cruise line, all sorts of things. Now, we know the cruise industry is not going away. It's very strong. It's a multi-billion-dollar business. But at current prices, we don't think the cruise lines are back to full speed. We think there's an awful lot of different countries looking at COVID in different ways still. And that's why we're not ready to get back on board with the cruises yet.
Okay, that's a good explanation there. And so how about some of the resorts? I mean, even Disney comes to mind there. Is Disney something you could look at as part of your portfolio either later, or have you held that in the past?
Yeah, no, we've certainly held Disney. It was a rather small holding in the portfolio. I think Disney's super interesting for their ownership of Star Wars and that whole franchise. But dollar in, dollar out. They have some geopolitical risk in Florida as well as around the world with Europe and China. So not really on board with Disney right now. Okay. But the questions you're asking lead me to another good point that we want to say about active management. Well, why would I weight one stock much more than another? I get a lot of good information. And the reason is I believe active management can thrive with a limited industry, a limited universe of stocks, like I said earlier. And then I do rely on certain tools of analyst ratings, earnings revisions. I get a lot of information. When I see that analysts are raising estimates for earnings, future earnings revisions, I like that. It causes me to buy. It causes me to overweight. Not waiting necessarily for the quarterly earnings to come out, but looking at a lot of tools for analyzing earnings revisions and how analysts are looking at those stocks. I also get a lot of good information from analysts, and I've learned which analysts I like, which analysts I tune out, which analysts might be unbiased in their good information, and which analysts might not be. So don't rely on an individual stock picker, rely on good information. But again, as a stock picker, I'm using that information as a good tool. And that's what causes me to have a top holding in something like Target Hospitality, which I think is a real interesting holding, again, that I mentioned that a lot of people might not be familiar with.
Yeah, that's right. I had to look it up when I was going through your holdings too. You mentioned a lot of the traditional ways to research stocks and the analysts and the reports. Specifically to beds, what sort of non-traditional ways do you use? Is there access to bookings, and are you looking out to see what type of reservations they have long term and how that compares to their historical averages?
No, great question. Great question about looking under the hood. And for that, I let analysts do their job.
Mm.
Sometimes trying to pick stocks, you lose sight of the forest through the trees. Getting too caught up in one booking here versus booking there, and what occupancy rates are. There's analysts that their full-time job is to look at these hotel companies, to sort out that information, and then put in their price targets, their ratings, their revisions, everything else. And again, some of those analysts I put a lot of weight in. Some of those analysts I tune out completely. You mentioned the thing about bookings. This fund, AdvisorShares Hotel ETF, if people think that's a good idea, it also has the ability to invest in Booking.com, Expedia, something that's a little bit different but related because it's more technology oriented, is Airbnb, another stock. We own some of those stocks right now. We're not really high on them. A little bit. Look at our top 10 holdings, get a good idea of what we like. A number of holdings that we mentioned, like Target Hospitality, Blue Green Vacations, Playa. Those are resorts in Caribbean and Mexico. And those are some that people might not be too familiar with, combined with, peppered in with Hyatt, IHG, Marriott, some of the others. Also casinos. Casinos are very much in the hospitality and hotel business as well. So we also do take a close look, and at various times have owned big weightings in casinos.
How frequently do you change your portfolio?
In this particular fund, it's not rules based for weekly or monthly rebalances. We watch the portfolio on a daily basis. Are we turning the portfolio every day? No, not at all. But the portfolio can change on any given day, any given week. While I say that, overall, we aim for generally low turnover. Okay. When I talk about turnover in ETF, though, people really need to be aware of the difference between a typical ETF and a typical mutual fund. When you see a mutual fund, you see high turnover. If a fund's going up in value, it can mean taxes. It can mean taxable distributions. And that's where it's important for people to really understand the inner workings of an ETF. An ETF internally can be a lot more tax efficient than a mutual fund because of the way creation baskets and creation redemptions work. Now, we could spend a whole 30 minutes or more talking about that. I won't. But our turnover does not necessarily lead to taxes at all if an ETF is managed correctly.
And you mentioned about traditional ETFs that people think about that track indexes, and that's how they measure performance. What are the performance benchmarks for you, since you are in such a niche area with most of your funds?
Yeah, great question. And ETFs, when they started, were all index based, but there's nothing in the words exchange traded fund that means it's an index. Just like there's index mutual funds and actively managed mutual funds. So we internally compare to a number of other leisure funds, consumer discretionary funds, things like that for our own benchmarks to know that we're doing a good job.
Mhm.
But the fund officially on our website and in our annual report and prospectus just compares to the S&P 500. And the reason we do that is we don't want to get too cute, and we just want to give people a benchmark that, again, they know and understand. I think people also understand that the hotel industry is not supposed to track the S&P. It's going to be different than the S&P. Sometimes it's going to be better, sometimes it's going to be worse. But yeah, we just throw that out there as something for individual investors to compare to and know what it's doing. But we compare ourselves internally to a lot of inside industry, other comparable funds, to consumer discretionary, leisure, but there's very few specific travel and specifically hotel industry ETFs. And I think that's, again, a tool that people can easily understand and might want to invest in when they're diversifying their investments. As I say that, remember that a fund like this should be a satellite investment. And Brian, and what you do, I'm sure you educate a lot of investors about core investments versus satellite investments. No, don't put all your money in hotels, people. It's not meant for that. It's meant to be a satellite investment if it makes sense to you and you think it might be a good time to invest in hotels in that industry. That's what it's there for.
Right. This is for people who have a hunch. This is for people who have the, 95% of their portfolios over here, and then 5% is to follow their hunches and give people something to talk about at dinner parties and whatnot, right?
So, not necessarily that. I think it can be more, but
Okay.
but yeah, as I said, there's a lot of people out there that might think, yeah, that's a good idea. I travel. I see what's going on in the hotel industry. I've looked at these top 10 holdings, and there's some real gems in there. But yeah, that's what a satellite investment means. Not your core investment, but a satellite investment that can add some alpha, can add some performance to your portfolio, if hotels do better than the overall market. We think they can.
And you're involved in not just beds, but a number of other funds there. What has been gaining a lot of traction, getting a lot of interest from investors recently among the whole AdvisorShares portfolio?
Certainly, because we do have an awful lot of funds. Again, I manage some and others we don't. As I mentioned, we have AdvisorShares Hotel ETF, AdvisorShares Restaurant ETF. We have something certainly intriguing to many people, AdvisorShares Vice ETF. Now, years ago, I founded a mutual fund called the Vice Fund Mutual Fund. And it, like it probably sounds, invests in alcohol, gaming, hotels and hospitality, restaurants, and tobacco even. I don't think people are smoking more cigarettes, but I always know that cigarettes are the most profitable consumer product in existence. Very wide profit margins on cigarettes, unfortunately. The area that we've really been getting a great deal of interest in, people should be aware of, we have AdvisorShares Pure Cannabis ETF, ticker symbol YOLO. AdvisorShares Pure US Cannabis ETF, strictly United States-based cannabis, ticker symbol MSOS or MSOs. That's actually the largest cannabis or marijuana fund in the world. It has been down. There's been a drawdown over the last 18 months or so, since there was a lot of hype after the last presidential elections and Senate runoffs. Cannabis stocks spiked an awful lot. They've been down for, from those highs a good 18 months or so. But a lot of people think federal reform of cannabis is coming. And once again, AdvisorShares Pure US Cannabis Fund, MSOS, that's the largest cannabis fund in the world.
What sort of regulatory hurdles did you have to get those approved? Anything different than your normal drone fund or hotel ETF?
A lot of work. I will say that here at AdvisorShares, we have very good partners. A lot of conversations with the Bank of New York Mellon. It's one of the biggest custody banks in the world, and we had to have a lot of discussions with them, put in special rules in place for cannabis, a lot of conversations with the New York Stock Exchange, NYSE, and they were good partners as well. They worked on a number of rule filing amendments, filings with the SEC. Our AdvisorShares Pure US Cannabis ETF was in its registration for an entire year. The SEC asked us to go get a legal opinion, a third-party legal opinion from another firm about cannabis stocks in the US and how we could have exposure to them. So we were very upfront, a lot of communication, a lot of work behind the scenes to bring that fund to market. And a lot of people have copied us since that time. We were sort of groundbreaking in some of the tools that we used inside of that fund to get exposure to U.S. cannabis stocks.
Yeah, it's definitely a copycat industry. It's very much like
Sure.
NFL and a lot of other sports, right? Once somebody does something that works, everybody's all in.
And that's fine with us. Sometimes it's the best form of flattery to be copied.
And that's still been getting a lot of traction. Yeah, I understand that the regulatory hurdles, a lot of it was on the custody side and the banking regulations, right?
Yeah, very much so. And again, we work with one of the biggest custody banks in the world, but if you do things right, if you do have a lot of communication, spend a lot of money on good lawyers, and but we think we did everything correctly and worked with very good partners in the New York Stock Exchange and Bank of New York Mellon, and provided a lot of information to the SEC so they could do their job and approve these things. Yeah.
All right. Well, I want to get your feel maybe for the whole ETF industry and where you think that's headed. We've had a lot of recently, the last month or so, a lot of single stock ETFs, a lot of that going on, some more leverage stuff, which again, we could probably spend a whole episode on 2X, 3X funds. We're not going to do that, but what are your thoughts on some of the innovation and where the next sort of lane for firms like you to run in is going to come from?
Well, it's constantly evolving. Just like I said, when we first started, 12 years ago, we had to have certain exemptive reliefs that we had to get from the SEC and from attorneys, and those are no longer needed. But ETF rules are constantly evolving. The SEC is bringing in new rules about derivatives and their use and how much leverage you can have in a fund. So it is constantly evolving, and single stock ETFs, like you said, came out. And I don't know if those are going to be a big hit, if that's what the world really needs. But we've seen a slow progression of more and more mutual fund companies, the old line mutual fund companies, getting into the ETF space. And it's because it's what advisors want, and it's what investors want. Now, do I think mutual funds are going away? No. There are trillions of dollars in mutual funds, especially when you get into pensions and endowments and 401ks and everything else. But most new investment dollars are going much more into ETFs. Now, they're still going in an awful lot to SPY and the other biggest index funds, and that's fine too, because firms like us at AdvisorShares want to provide those extra pieces that advisors and investors really want. And it's a good way to get exposure to cannabis or hotels or restaurants. So we try to be an innovative firm, but everything we do is going to be actively managed, providing certain types of products to investors that want them. And as I'm saying that, one other thing I should say for your listeners, we have 2 short funds. And when I say that, I mean we have 2 funds from different managers that are sub-advised that short individual stocks. One is more quant driven, one is more fundamental driven. They're looking at companies that they think should be shorted. It's different than an inverse fund. An inverse fund is a daily reset. It's the opposite of the SPY, for instance. These are deciding which stocks they want to individually short. And I'm saying this because it was innovative when we did it. And it can be a very good tool for advisors or individual investors that want to hedge their portfolios. If they're long SPY and they want a certain risk level in their portfolio, using a short type fund can be a good hedging tool.
That is an interesting tool because unlike the direct inverse funds, that is something that in theory could also be up when the overall market is up. If the overall market is rewarding good stocks and your fund is penalizing bad stocks, it could in concert, actually, go with markets on the upside. So it's different than something that is inversely correlated to the market.
Exactly. Yep.
All right. Really interesting stuff. Well, I guess we're up against half an hour. We could probably go all day, but want to thank Dan Ahrens, Managing Director, Chief Operating Officer at AdvisorShares. A lot of good products out there for your Explore part of your Core and Explore. And so check out their website and see if there's something that scratches your itch. Right, Dan?
That is correct. Look at our website, and I'd be happy to be back on another time, Brian, because we have a lot of paths we could go down in these conversations.
Yeah, we really do. I think we uncovered 3 or 4 shows during the course of the last 30 minutes. All right. Thanks a lot, Dan.
Thank you.